Chinese inflationary pressures remained weak in April, with consumer prices slipping 0.1% year-on-year, unchanged from March, and the third straight monthly decline. Core inflation, which excludes volatile food and energy prices, held steady at just 0.5%, well below the 2% level loosely targeted by the PBOC. A sluggish property sector, elevated household debt, and job insecurity are weighing on domestic confidence, keeping spending and investment in check. The government has rolled out a raft of stimulus measures in response, including interest rate cuts and liquidity injections, aiming to revive activity and guide inflation back towards its new target. However, at this stage, large-scale fiscal support remains absent. Further up the supply chain, disinflationary forces are proving stubborn. Factory gate prices fell 2.7% year-on-year, the sharpest drop in 6 months, and April marked the 31st consecutive month of annual producer price deflation. As seen in the following chart, there are clear linkages between Chinese producer prices and import prices for major nations such as the United States and Germany. At the margin, some relief may be in sight following constructive trade talks between the United States and China over the weekend. While we don't know the details as yet, the resumption of dialogue has helped ease concerns about further escalation, reducing downside risk to international demand for Chinese goods. That may help temper deflationary impulse from trade tensions, at least for now.